This is a short, simple video on bond investing. By the end, you'll be smarter than a fifth grader in the proverbial school of finance, and way smarter than the folks calling the shots at Silicon Valley Bank. People think of bonds as safe investments relative to stocks, and this is generally true. Stocks are associated with uncertainty because their price can swing wildly at any given time based on new developments at the company and its competitors or the economy and its markets. By contrast, U.S. Treasury bonds, which are generally considered the safest bond investments there are associated with many virtual certainties. When you buy one, you know how much interest you'll receive and when that's paid, and you know how much principal you'll receive upon maturity and when that's paid. Despite these certainties, there's still one big uncertainty associated with even the safest bonds: the price. Even though the interest rate your bond pays doesn't change after you buy it, the interest rate that prevails in the market does. As the market's interest rate rises, your bond's price falls, which means you can take a loss if you sell it after interest rates rise. You've probably heard that many times before. When interest rates rise, bond prices fall. But if you're a normal person who's focused on the daily responsibilities of your career or raising a family, you may not have heard that with long-term bonds, rising interest rates hurt prices much more than with short-term bonds. This is a reality for bonds that professional bankers learn in Finance 101, just like gravity is a reality for baseballs that MLB players learn in Little League. So, if you're investing in bonds with your own money, now you know that all else equal, short-term bonds like 1-year and 2-year bonds are generally safer than long-term bonds like 10-year and 30-year bonds. And I think this goes without saying, but if your friends ask you to hold on to their money and keep it safe, and you see they may ask for the money back soon because they're going through a tough time, and the most powerful person in the market is telling you repeatedly he's going to raise interest rates, and the interest rates on long-term bonds are actually lower than the interest rates on short-term bonds, you probably shouldn't invest your friend's money in long-term bonds. But again, I think that goes without saying. You'd have to be pretty stupid to do that. If you found this video helpful, do you mind if I ask for your help with something that just takes a second? If you click the subscribe button, it would be a tremendous help for me. My mission is to share this type of educational content with as many people as possible so that we can raise the bar for what we expect from the financial industry. Because right now, it's full of way too many people like this. If you click the subscribe button, it helps because it tells me and YouTube that more people want to see this type of content. And with that, thank you very much for watching. It's been a pleasure, as always.